welcome to Let's Talk Tax, the show for growth-minded CPAs and real estate pros in tax. I'm Jerry Hammel. In today's episode, we will dive into the recently passed legislation for the One Big Beautiful Bill. Joining us today on Let's Talk Tax is David Seibel, shareholder of our R&D Credit practice. Welcome, David.
Thanks for having me, Jerry.
Yeah, it's my pleasure. I think you and I have been speaking quite a bit about the recently passed legislation that came out of the House, which they call One Big Beautiful Bill, which is hard to say that without smiling. But,
Correct.
Yeah. You know, what I wanted to do today is just kind of pick your brain and talk a little bit about Section 174.
Mm-hmm.
So maybe you can give it a quick update. I mean, without diving into 174 completely in the House bill, what's the big change?
Yeah, so the big change, if the One Big Beautiful Bill would pass, is that there would be a restoration of deductibility for 174 expenses, full deductibility for tax years 2025 through 2029. So it'd definitely be a great benefit for those taxpayers that have had to amortize their 174 costs over the last couple of years. It is important to note that it wouldn't be retroactive. It would only be for 25 through 29. So unfortunately, 22 through 24 taxpayers would still be required to amortize those 174 costs. And at least the House version of the bill that was passed, there's no type of catch-up adjustment or accelerated deductions. So those would continue to play out over the next couple of years until those are fully deducted on their normal 5-year or 15-year schedules.
Okay, and if I recall, the change from TCJA, the required amortization, that began with the 22 tax year?
Correct. Yeah. So it would be for tax years beginning after December 31st, 2021. So yeah. So currently it would be for the 22, 23, and 24 tax years. Each year is for domestic expenses is amortized over 5 years. Or in the case of foreign expenses, 15 years. And one thing I neglected to cover is that this deductibility change would only be for domestic expenses. So foreign research expenses would still be subject to that 15-year amortization schedule, which, if the incentive is for homegrown research and for research in the U.S., it makes sense that they would continue with that 15-year foreign research regime.
Sure. And this has been a long-awaited change, one that many practitioners thought would never come into being, in terms of the required amortization. So this fix has been hoped for quite some time now.
Yeah, it's definitely something that a lot of our relationships or CPA relationships and their clients have been, again, looking forward to for a long time. It's been real big hardship on those companies that are doing research over the last couple of years. So this will definitely provide some much needed relief for them going forward.
Mm-hmm. Well, not to peel back 174 in the House bill completely, but maybe if we could just hone in on maybe one interesting twist. I think when the required amortization came into effect, speaking with CPAs all across the country and speaking with their clients, a lot of people really were looking at, okay, do I continue to take the R&D credit, which is actually Section 41, for 22 and 23 and 24. And I think there's I don't know a number, I don't know a percentage, but there were a fair amount of taxpayers that took the position that they no longer did research and really to get around the required amortization, which was a pretty big negative impact on their taxable income. I mean, it would have cost them quite a bit in tax dollars.
Yeah, absolutely. Yeah. So
yeah.
I mean, there were plenty of taxpayers who, again, to your point, just took the position that they didn't do research and they thought that they just wouldn't claim the R&D credit and that would pretty much excuse them from having to amortize 174, whereas to your point, Section 41 is the research credit, and it's just a small subset of expenses that are 174 research expenses, which, again, is not an optional thing. The R&D credit is optional, but Section 174 amortization is not optional. So we definitely had a fair amount of taxpayers take that risk to just kind of take that presumably aggressive position that they weren't doing research.
Sure. And so, a fair number of taxpayers continued with claiming the R&D credit, amortize their 174 expenditures. This is certainly welcome relief for them that they can now currently deduct those expenses, at least in the House bill. It's assumed that it's going to pass the Senate, but we'll wait and see what edits and modifications are made to the bill. But for those that chose a different path, that did not continue with the R&D credit, if I think about this, there's a 3-year gap now that current year expensing will presumably be reinstated. A lot of those taxpayers probably want to revisit taking the 41 credit. And I guess my question to you would be, what's the risk in just going back into 2025 and just beginning to deduct those expenses and claiming the R&D credit in 25?
Yeah, there certainly are probably a fair amount of taxpayers out there that think, oh, well, I'll just start claiming the research credit again in 25, fully deduct my expenses, and it's, it'll just be business as usual. But, from a compliance standpoint, as we pointed out before, 2022 through 2024 tax years, that's still the law that you have to amortize those expenses. So if there was an exam situation that popped up, the IRS might take a look and say, well, looking back at these expenses, you claimed the research credit in 21, you claimed the research credit in 25, you didn't claim the research credit in 22 through 24, and you also didn't amortize any expenses. So what, can you walk me through that? And it's something that, taxpayers probably don't want to find themselves in a position on trying to argue one way or the other. Either they did have research in 25, but they didn't have research in 22 through 24 in that 3-year gap. And basically, they don't want a situation where they're pitting those years against each other. So, we've actually worked with a couple of IRS agents and former IRS agents to, just talk through, try to improve our studies. And, they indicated that the IRS does have a list. They do know who that exact situation of they claimed the research credit in 21, but then they didn't claim it in 22 and didn't amortize anything in 22. So if they're aware of it, maybe they haven't necessarily enforced it, but it's definitely on their radar. So it's a situation where, taxpayers that are claiming the 25 research credit and going forward probably need to do some due diligence work in 22 through 24 to make sure that they're in compliance with 174.
Because the risk is, I would assume, David, that the risk is if they start claiming the credit in 25, that now if they are on that list, for example, and they do get selected for examination, one risk is they have exposure for the IRS to come in and really examine 22, 23, and 24 and make them amortize those expenditures, which would result in a tax bill in 22, 23, and 24. So if they just jump back into claiming the credit, from what I understand from what you're saying, and I agree, is that they have some exposure there for those years, those interim years of 22, 23, and 2024. Fortunately, though, as you and I have talked about, there appears to be a little bit of a window here to possibly reduce that exposure. Do you want to talk about that a little bit?
Yeah, absolutely. So for if we're strictly talking about 2025, and for those taxpayers that want to be start claiming the research credit and want to be in compliance with 174, we've had a lot of talks with CPAs, and they think, well, my clients not going to want to do that because there's going to be this huge barrier to entry, because there's going to have to be a 481A adjustment for all those deductions that they shouldn't have deducted in previous years for 22 through 24. And they think it just creates a huge barrier to entry to get them into compliance. But while that number can be significant, it's important to note that 481A adjustment, that positive 481A adjustment, would be spread out over 4 years. So you wouldn't be necessarily you wouldn't be taking that tax impact all in the 1 year. you'd actually be spreading it out over 4 years. And when we were doing some rough numbers and some rough math, it's actually pretty beneficial for taxpayers to get into compliance. There's not as much pain as one would expect, because you're taking those over the 4 years, that 481A adjustment, but then you also are going to be taking those deductions for 22, 23, and 24 for amortizing them as you normally would. So, the rough example of having $1 million of research expenses every year, you have a 481A adjustment of about $525,000 each year, but then you have, for at least the first couple of years, $600,000 in deductions to offset that that additional tax liability. So it really doesn't create much pain at all. There's a little bit as the deductions wind down in 27 a little bit, and then 28 there's kind of a modest impact there, but still something that's tolerable, it's manageable, and something that, again, in 2028 companies can appropriately plan for, to be able to minimize the pain associated with that year.
So to maybe put some context in years, so you would make that change, and I believe this is all coming from Notice 2023-63.
Correct. Yes.
Correct. Yeah. And so we're getting this right out of that notice, and you would make this change under a cutoff method with 481A. Not to get too technical about the calculations, but in summary, it would basically, you'd take in that 4 years of adjustment in 25, 26, 27, and 28.
Correct.
And if I'm hearing you correctly, the required amortization for those open year 22, 23, and 24, those would offset that 481 positive adjustment each of the 4 years. It offset it completely with actually a net deduction for 25 and 26.
Yep.
27 would be a income add back of about 25,000 in our example.
Correct.
And then 28 would be a larger amount because the amortization deductions have fallen off for those earlier 2 years. But it's a unique opportunity to get back in the fold and approaching the IRS with an accounting method change versus just starting to claim the 25 credit and just hoping for those 3 years and really being beholden to the IRS if they come in and do challenge it and try to assess those years.
Yeah, it's just about making sure that you'll be in compliance, because in your example with coming back and they examine 22, 23, and 24, and there's a tax adjustment there, you're not just looking at the additional tax owed, but you're looking at penalties and interest as well. So this method will definitely help you get into compliance. And it's, as I said before, this is not a barrier, but it's more of a gentle ramp to get you back into compliance. And that's even just strictly looking at from a 174 perspective. We haven't even touched upon the research credit, which would be an added benefit. Not even just looking at 2025 and going forward, but also the opportunity to go back and amend 22, 23, and 24 could be an opportunity to either generate a refund for those years, or if you have the tax liability, be able to carry it forward to offset some of that additional tax liability that comes in play in 27 and then 28 as well. And really, it just presents a really good tax planning opportunity for CPAs to perform with their clients to make sure that they're in compliance, and then also not leave any money on the table when it comes to the R&D credit.
Sure. And I think maybe one thing to point out with this notice is that this accounting method change, while it doesn't come with audit protection, correct?
That's correct. Yeah. So it doesn't audit protection wouldn't apply in this instance. So again, it just makes it so that you should make sure that you're, again, getting into compliance for those years.
Which just means that you ought to probably do a pretty good calculation to ascertain what the 174 costs are, so that when you come in and make this adjustment, that you've done your homework, your due diligence, and you've got a good calculation. Right.
Yeah. It wouldn't just be, taking, just a kind of a thumbnail or thumb calculation or anything like that. It would just, definitely have to do your due diligence, make sure that you're following the relevant or IRS guidance to make sure that you have the correct numbers in place to be able to amortize correctly.
Sure, but they put it in the notice for a reason, and I think, as you and I have talked about, I think this is a great avenue to get back on the claiming the 41 credit, and it's a really good way to what I call sleep peacefully at night, and really address those interim years where the amortization was required, but yet get back and claiming the R&D credit really for 22, 23, 24, 25, and forward. Through that extended period that's in the House bill.
Yeah, again, it just makes perfect sense. It's a good opportunity to make sure that no money is left on the table, and again, getting into compliance proves it's not going to be too big of a headache to do. So again, it just presents a really good planning opportunity to start having for CPAs to have with their clients now as a strategy, just to see what's available, what they might need to do.
Yeah, and I know you and I have also talked about, there was a new section on the Form 6765 this year. We call it Section G. It wasn't required for 24 tax years, but it is for 2025 tax years. And we're not going to dive into that. I believe we've got an upcoming episode on 174, and I'm sure we'll blend in there a little more detail on this new section. But one of the advantages I could see with also getting back and doing the 3115, the accounting method change, is that you could actually get prepared for this Section G requirement and rolling into the 25 tax year.
Yeah, for sure. That's why it probably makes sense to start having those conversations now, because especially for those clients that did just skip the research credit from 22 through 24, the form has changed. The reporting requirements are a little bit more in depth. So being able to prepare, look at, since we're about halfway through 2025 now, being able to look now and assess, okay, what information do I have now? What information will I need to have for this form, so that you can go back and see what systems do I need to have in place going forward to make sure that I can accurately track and report, track things appropriately going forward, as well as looking back for the first 5 months of the year to get anything that needs to be sorted out. So again, you're not looking at this time next year and trying to recreate everything for the entire year
from scratch. And then very good. I think it's kind of interesting for those that did go away from claiming the 41 credit and did not amortize 174. It's interesting to me that this is a pretty unique opportunity when I look at it, where you can get back in the fold from a compliance standpoint and really be in a pretty good position to get back in line and start claiming the 41 credit, and really getting in compliance with the 174 rules, for which taxpayers may have missed for that 3-year period.
Yeah, I mean, it's unquestionably, when we looked at the numbers, we had to check them and double check them to make sure we were seeing things correctly. But yeah, I mean, it undoubtedly provides a great opportunity for those clients that, again, skipped over 174 amortization for one reason or another, skipped out on the research credit. To your point, brings them right back into the fold with minimal pain, and again, allows them to take advantage of this great tax benefit of the R&D credit going forward.
Yeah, well, David, I appreciate this conversation, and I think maybe before we wrap up, let's just summarize maybe our message to CPAs or taxpayers out there. I think number one, this opportunity exists, as we've talked about today. Number two, while it's not law yet, there's no time like the present to get ready for this, and maybe go back and review the taxpayers or your clients that chose a different path when the amortization was required, and really get this message out to them and come up with a plan as soon as this is enacted into law and signed by the president. Come up with a plan really to reach out to those clients and show them how they can get back in the fold and get back to claiming the 41 credit and be in compliance. Any other messages, or did that cover most of that?
I think that covers it. There's obviously going to be a lot of other tax planning opportunities once this bill is signed that are other than 174, but this is definitely one piece for those clients that are conducting research or have traditionally claimed the R&D credit, to make sure that you're having those conversations so that, again, they can plan appropriately.
Yeah. Well, this is a bit of a good news on the 174 front. We haven't had a lot of good news in the 174 area
Right.
for about 3 years. We were very optimistic, I think, in 21, and that optimism was shattered. So
Correct.
It's nice to see this, and it's also nice, it left a lot of uncertainty, where I think it really put taxpayers and clients in a really bad position, both financially and just from a compliance standpoint. So I really appreciate you joining us today and sharing some of this knowledge. And I know if any of our CPA firms or clients that would like to talk about this, I know that you and your team are readily available to have these conversations and to explore what this would look like. And so if anyone does have any questions or would like to discuss it further, both David and I are available, and we have several other members on the R&D team that can walk you through this. So please do not hesitate to reach out, and we'd be happy to explore this with you. So David, I just want to say I appreciate your expertise. I appreciate you leading our practice, and definitely appreciate the time spent today. And I hope a lot of our listeners will get something of value out of this conversation today. So thank you very much.
Yeah, thanks for having me, Jerry.
Thank you for taking time to tune in today. You can subscribe to Let's Talk Tax Podcast on YouTube and follow us on Spotify or Apple Podcasts or wherever you listen. In addition, today's show notes and links to more about the episode can be found online at McGuiresponsel.com. We'll see you next week. Thanks, everyone.